Welcome to Iron Financial. This is the place where we forge stronger portfolios by putting companies and their financials through the fire. Today, we're taking our tools to an absolute titan of the energy sector, Canadian Natural Resources. You know them by the ticker CNQ. Look, this company isn't just big, it's a behemoth, a giant of the oil sands, with a market cap that could probably swallow a small country's GDP. But in this market, you and I both know that size is no guarantee of strength. So we're here to do one thing: run a full financial stress test. We're going to hammer on the weak points, we're going to test the load-bearing walls, and we're going to find out if this thing is built to last or if it's about to crumble under its own massive weight. I'm your lead analyst, and with me, as always, is our market skeptic. His job, to ask the tough questions and find the cracks in the armor. Let's get to it. Okay, let's just dive right in. On the surface, if you just read the press releases, CNQ looks like an impenetrable fortress. I mean, they just dropped the report on 2025, and they called it, and I'm quoting here, the best operational year in the company's long history. We're talking about record-breaking production, huge returns to shareholders, the whole 9 yards. But, and this is the core conflict, the one question we have to answer today, in a sector as notoriously volatile as energy, where the price of oil and gas can turn on you in a heartbeat, is this strength for real? Is that foundation made of solid iron? Or is it just a really well-polished facade, a house of cards, just waiting for the next gust of market wind? That's what we're here to find out. All right, so before we start swinging hammers, here's our blueprint. This is how we're going to deconstruct this company piece by piece. First up, we're going straight to the engine room, production. Are the numbers they're putting up real? And more importantly, can they keep it up? Second, we're going to inspect the margins. Look, massive revenue doesn't mean a thing if it's all just bleeding out in costs. Third, and this is the big one, we are putting the debt load under a high-powered microscope. This is where we usually find the real foundational cracks. Fourth, we're going to examine the payout. What are you, the shareholder, actually getting for taking on all this risk? And finally, we deliver the iron financial verdict. We're going to weigh all the evidence and tell you if this is a structure you want in your portfolio. Let's get started. Right. Section 1, the production engine. This is the top line. This is the raw horsepower of the entire company. Before we can even begin to talk about debt or margins or dividends, we have to understand what is physically driving the revenue. Are they actually pumping more oil and gas out of the ground, or are they just getting lucky with high commodity prices? So let's look at the raw output. This is about physical volume, the sheer, undeniable scale of their operation. And here it is, the headline number that got everyone's attention. For the full year 2025, CNQ pumped out a record 1.571 million barrels of oil equivalent per day. But the number itself isn't even the most impressive part. It's the scale of the growth. That figure represents a 15% year-over-year increase. Now, for a company of this magnitude, growing your physical output by 15% in a single year, that's like getting an aircraft carrier to do a sprint. It is a massive, massive display of operational strength. And it was fueled by a smart combination of organic growth from the assets they already had, plus some really strategic, accretive acquisitions they made during the year. This isn't just a small uptick, folks. This is a fundamental step change in their output capacity. Okay, 15% is a huge number. I will absolutely give you that. But in this industry, a one-year pop can be a total fluke. It could just be a flash in the pan, maybe fueled by an expensive acquisition that they're going to be paying for years to come. So the real question for me is, can they keep the pedal to the metal? Or are they about to slam into a wall? Is this amazing growth story already over? That's what I want to know. Well, that's the right question to ask. And if you look at their guidance for 2026, they've already answered it loud and clear. This table shows their updated forecast, and what you'll see is that they're not just sustaining these record levels, they are increasing them. They're now targeting a midpoint of 1.64 million barrels per day. That is another significant jump from their record-breaking 2025. This isn't a one-time surge. This is planned, it's engineered momentum. They're literally building a bigger engine while the machine is running at full speed. And this quote from the company's president, Scott Staff, it really tells you where that confidence is coming from. He's not out there talking about hoping for higher prices or chasing some risky long-shot exploration project. He's talking about their unparalleled assets, execution, and resilience. Okay, but what does that actually mean in practice? Assets and execution, that sounds like the kind of corporate jargon you hear from every CEO. It means they own something special, something called a long-life, low-decline asset base. Now, in simple terms, that means their wells and their mines don't need a massive, constant fire hose of cash just to keep from shrinking. They have a foundation of assets that are going to produce for decades with relatively low maintenance costs. That right there, That's the bedrock that lets them plan for reliable, steady growth, instead of being stuck on an endless exploration treadmill like a lot of their peers. Okay, so the engine is big, and it's getting bigger. Point taken. But a bigger engine just burns more fuel, right? All that production is completely worthless if they're losing money on every single barrel they pull out of the ground. And in an inflationary environment where the cost of steel, the cost of labor, the cost of energy itself are all going up, costs are the enemy. So let's move on to the second part of our stress test, fortifying the margins. Can they actually defend their profitability, or are rising costs just eating them alive from the inside out? Excellent point. And this is where that operational execution he was talking about becomes absolutely critical. And what's so impressive here is that they pulled this off during a period of widespread howling inflation. Just look at this bar chart. These are the operating costs for their oil sands mining and upgrading division. This is a core part of their business. In 2024, it cost them $22.88 to produce a barrel. Now, in 2025, a year where everyone and their brother was screaming about inflation, that cost actually went down to $22.66. Okay, but it's a pretty small decrease, right? 22 cents, is that really something to write home about? On its own, no. But the fact that it didn't skyrocket by 10 or 15%, like we saw with so many other industrial companies, is a testament to extreme cost discipline. They are holding the line. They're even gaining a little ground against some really intense cost pressures. This shows an iron grip on their expenses, which is exactly what you want to see when you're stress testing a company's durability. So holding the line on costs is one thing, but what about the other side of the equation, the revenue? We all know they're a huge player in Canadian heavy crude, and the price differential on that stuff can be absolutely brutal. So what happens if the price of heavy oil collapses while light oil stays high? How exposed are they really? I mean, are all their eggs in one very volatile basket? That is the classic risk for any big Canadian producer. But CNQ has actually engineered a structural defense against that very problem. This chart here, it shows their targeted production mix for 2026. Just look at how balanced it is. Only about a quarter of their production is actually heavy crude oil. A massive 49%, so nearly half, is light crude, natural gas liquids, and synthetic crude oil, which are all products that often trade at a premium to the headline price. Then another 26% is natural gas. This is not just a heavy oil company, it's a truly diversified energy producer. And this mix acts as a natural hedge. If heavy oil prices are weak, they can still make a killing from strength in natural gas or light oil. It's a deliberately built-in shock absorber for their entire revenue stream. Okay. So the engine is strong, the margins are defended, I get it. But now we come to the part of the inspection that, for me, really matters. The foundation. All of this operational strength, all of this production growth, it can all be undone by one single thing: debt. A mountain of debt can make even the strongest looking company incredibly fragile when a downturn hits. So is this Canadian Natural's Achilles heel? Are there cracks in the financial foundation that could bring this whole thing down? Let's analyze the debt load. And we are not going to sugarcoat this. Here is the number in stark relief. At the end of 2025, the company's net debt stood at just under $16 billion. Let that sink in for a second. That is a massive number. It is a figure that absolutely demands scrutiny. Anytime you see a B after the number, you have to stop and analyze exactly what that means for the company's stability and its flexibility. This is the weight that the entire structure has to support, and there's no question it is a heavy lift. But a number that large is pretty much meaningless without context. So here's the crucial number you really need to see: 26%. That was their debt-to-book capitalization ratio at the end of 2025. All right, explain that. Why is that ratio so much more important than the $16 billion headline number that scares everybody? Because in a capital-intensive industry like energy, companies have to carry debt to fund their massive projects. It's just a normal part of the business. So the question isn't if they have debt, but how much debt they have relative to the actual value of their assets. This ratio measures how much of the company is financed by debt versus how much is financed by equity. And 26% is not only comfortably within their own internal target range, it is miles below their debt covenant limit of 65%. Now, if they were to hit 65%, their lenders would start calling the shots and could restrict their operations. At 26%, they are in a position of complete control and absolute strength. So yes, the absolute number is large, but relative to the size and value of the company, the load is very manageable. Okay, so the ratio is fine for now, but what are they actually doing about that $16 billion number? Is there a clear plan to bring it down, or is that just a weight they plan on carrying around forever? Because a manageable load is still a load, and it must cost a fortune in interest payments every year. And they have a crystal clear, publicly stated plan to reduce it. It's not some vague promise, it's a formula, as you can see right here in this breakdown of their free cash flow allocation. It's a tiered system that is specifically designed to aggressively attack the debt while still rewarding shareholders at the same time. Right now, with debt just under $16 billion, they're sitting in that middle tier. So for every single dollar of free cash flow they generate after their base dividend is paid, 75 cents goes back to shareholders through buybacks, and 25 cents goes directly to paying down that debt. And what if free cash flow just dries up in a downturn? That's always the risk. But this policy also acts as a guide. In a tougher environment, they would likely pause the buybacks to protect the balance sheet. But the real key here is the carrot at the end of the stick. Once they got that debt below $13 billion, 100% of that excess cash goes straight back to shareholders. It is a transparent, disciplined, and incredibly powerful deleveraging machine. They are systematically dismantling the debt load. And that brings us directly to the fourth section of our analysis, the reward. We've assessed the engine, we've gone over the margins, and we've hammered on the risks in the foundation. Now we have to look at the entire reason for owning a stock in the first place, the return of capital to its owners. So let's see how CNQ actually forges returns for the people who put their capital on the line. Okay, just take a look at this timeline for a moment. This isn't a story about one good quarter or one good year. This is about a culture of shareholder returns that has been forged over decades. They started paying a dividend way back in 2001. And every single year since then, through the financial crisis of '08, through the oil price collapse of 2014, through the pandemic of 2020, they have increased it. 2026 marks the 26th consecutive year of dividend increases. Now that is impressive. Consistently raising a dividend through those kinds of market shocks is a very serious sign of durability. Exactly. This is the mark of a true dividend aristocrat. It signals an unwavering, ironclad commitment to its shareholders that clearly transcends the boom and bust cycles of the commodity markets. A long streak is impressive, I'll give you that, but are the increases actually meaningful? A company can raise its dividend by a fraction of a penny just to keep a streak alive. Is this real, substantial growth we're talking about, or is it just symbolic? It is as real as it gets, and this number right here shows the incredible power behind that streak. The number on your screen is 20%. That is the compound annual growth rate, the CAGR, of their dividend over that entire 26-year period. This isn't them just squeaking by with token increases to keep the marketing department happy. This is aggressive wealth compounding growth. It means the dividend payment has, on average, grown by 20% every single year for over a quarter of a century. That is how you build a financial fortress for your shareholders. And this just proves that it isn't some legacy story from the past. It is a living, breathing policy that continues to deliver right now. Just recently, the board approved another 6.4% increase, bringing the annualized dividend up to $2.50 per share. That's a clear signal that management sees continued strength ahead, and they are absolutely committed to sharing that success directly with you, the investor. And the dividend is only one part of the story. In 2025 alone, the company returned a staggering $9 billion to shareholders. And the real key is how they did it. This breakdown shows a very balanced three-pronged strategy. First, you have the foundation, $4.9 billion paid out in cold, hard cash dividends. Second, opportunistic value creation, $1.4 billion used to repurchase and cancel their own shares, which makes every single remaining share that much more valuable. And third, strengthening the foundation, $2.7 billion in net debt reduction. So wait, you see paying down debt as a direct return to me, the shareholder? Absolutely, 100%. Every single dollar of debt they pay off de-risks the entire company and increases the intrinsic value of your equity stake. It is an indirect but an incredibly powerful form of return. This isn't a company just throwing cash around. This is a masterclass in disciplined capital allocation. All right, we have run the gauntlet. We've stress tested the production engine, we've inspected the margins, we've hammered on that debt foundation, and we've analyzed the entire shareholder payout structure. Now it's time to step back, look at the whole picture, and deliver the iron financial verdict. Let's just lay it all out on the table. The bull case, the argument for this thing being a fortress, is incredibly powerful. You've got record production with a clear runway to even more growth. You have iron-fisted cost control in an inflationary world. You have a diversified asset base that acts as its own internal shock absorber. And you have that incredible 26-year streak of 20% compound annual dividend growth. That is a best-in-class operational and shareholder return story right there. But you absolutely cannot ignore the bear case. This is not a risk-free investment. That $16 billion net debt figure is high, period. Any major sustained collapse in commodity prices would put immense pressure on their ability to service that debt. And we've also seen that some of their short-term liquidity ratios, basically measures of their ability to pay their immediate bills, are a little bit on the tight side. Now, this could become a real problem if their cash flows suddenly dries up. And finally, valuation. The stock's price to earnings and price to sales ratios, which are simple ways to measure how expensive a stock is, are near their historical highs. A lot of this good news might already be baked into the price, which means you could be buying at the top. This is the facade argument. It looks great, but it's expensive and it carries significant financial leverage. And those are all valid points. The valuation concern, that one is real. You never want to overpay, even for a great company. You don't. And the risks that you just raised are the entire reason we do this analysis. But looking at the Wall Street consensus, it's pretty interesting to see a complete and total lack of dissent. Based on the analysts that we've surveyed, the consensus is a unanimous buy or strong buy. Not one single analyst is recommending to hold or to sell this stock. They've set an average price target of $48.50, which represents about an 8.4% upside from current levels, and that's not even including the dividend. Now, while we never take analyst readings as gospel, a 100% consensus is a pretty powerful signal that the professional community believes the strengths of the fortress far outweigh the cracks in the facade. So that leaves us with the final question, doesn't it? We've put the numbers through the ringer, we've tested the beams, we've checked the foundation. And on paper, this looks like a remarkably well-constructed fortress. But the market is never just about the numbers on the page, it's about navigating the storms you just don't see coming. A sudden global recession, a geopolitical shock that sends oil prices into a tailspin, things that their financial models can't possibly predict. Exactly. And that really is our verdict. Our stress test shows that the structure itself is incredibly sound, the operational excellence is undeniable, and that capital allocation plan is one of the clearest and most shareholder-friendly in the entire industry. The primary risk here isn't internal rot, it's external shock, a true black swan event in the commodity markets. So the question you, the investor, have to answer is this. Do you believe this management team and this incredible asset base have the iron will and the resilience to navigate that next storm? Based on their 26-year track record of raising dividends through crisis after crisis, they've certainly proven they can, but the future is never guaranteed. That's our analysis. Now it's your decision. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.